what is an investment? An investment is basically where, it's a little bit like the parable of the talents, if you're going New Testament on that. It's where you earn money, save some of it, and then put it to work. You could put it under your mattress where, if you put $100 under there and go back a week later, $100 is still there. You could invest it in a bond, which is, basically say to a friend, I'll give you $100, but when you give it back to me next week, I want $105 back. Interest, I want interest. So it's a bond. Or you can give that $100 to a friend who's, sells fruit on campus. That's his business, and he needs some capital to build that business, right? So that's almost like a stock. That's an ownership play. So you have some basic ways basic places you can put your money. You can just put it in a bank account and get some minimal interest. You can get some sort of return, which is a contractual guarantee. Of course, it depends if a week later your friend still has the ability to pay you back $105. But okay, that's at least the promise. He might renege on the promise. And then there's the ability to invest in businesses. And that's really what investing in stocks is. You're investing in a proportionate share of a business. So you become sort of one of the owners. And as such, your fortunes rise and fall with how well that business does. And everybody's heard stories of, in fact, I think one of the most recent large gifts to Georgetown University was from a man whose mother, I think, had been the secretary to the founder of IBM. And all those shares that she accumulated passed to him, and then passed to him, and then he died, and then Georgetown gets $80 million or whatever it is. So it grew. It was not under a mattress, right? Because it would still be 25 cents or whatever she saved during the Depression. So that's the way it grows. So there are a lot of myths that grow up around that, right? There's the cliches as well. Things like buy low, sell high, things like that. Rebalance your portfolio. It's the asset allocation that matters, things like that. How much do you have in cash? How much do you have in bonds? How much do you have in stocks? Do you have ownership interests, or do you own stock in large companies? What's your risk there? Are you taking a flyer? Are you investing in your friend's startup? That kind of thing, where the return might be great if it works, and if it doesn't, you might be out. Everything, right? You can even think of buying a lottery ticket as an investment, right? So the odds aren't that great. But if you win big. You could call that gambling. Any number of things. And so that line, by the way, is a fine line. What is gambling? What is investing? That's a fine line. So one of the questions we had is why invest? And basically what you're doing is you're taking care of the future you, right? So you here will be me in 30 years, right? And what have you done now? That's when do you get started, and how much should you start with? What have you done now to take care of future you, right? You really, and I don't know, what obligation do you have as current you to future you? It's coming, right? Time marches on. Time's arrow is one direction. So what are the benefits of investing early? And that goes to the issue of compounding. I think I had a quote up there from Einstein, but he has said that compounding interest or compounding is the eighth wonder of the world. And that is the idea that if you save $100 today and it doubles, it's 200, doubles. That's compounding, right? That is a very powerful thing, so that if you start earlier, that early money will have time to double 5, 6, 7, 8 times by the time you retire, which is huge. I'll give you an example of it. The only thing I'll use the computer for is to give you a little bit of example of that. But compounding is huge. So why start early? Because everything you do now makes so much more of a difference. Where should you put it? That's sort of the $64,000 question, right? That's the big question. How should I invest? What should I do? What strategy should I follow? And there's a professor at Georgetown in the finance department that says, unless you're using tips, and I'll explain what those are, unless you're using tips, you're financial guessing, not financial planning. Tips are Treasury income protected securities. Basically, they're bonds, promises issued by the U.S. government. And the government says, you would give $10,000 to the government, and they would say, I'll tell you what, I'll pay you back in whatever number of years you designate, let's say 30. I'll pay you back in 30 years. Well, you know they're good for it because they can print money. So that you don't have to worry about credit risk. They might have debased the currency, but they will be able to pay you because they can make it up. So that's great. And then the other thing they do with a tip is it's Treasury inflation protected securities. So what they'll say is, we'll pay you back interest. Not only that, but we'll guarantee that the interest, your repayment, it keeps pace with inflation, the Consumer Price Index, CPI. So you know you're going to get your money back in real dollars, right? So when I was growing up, for a penny, you got 2 pieces of Bazooka Joe bubblegum, and a soda was 25 cents. It's not, it's $1.86 now, Weiss's or whatever it is. So that's inflation, right? That's the same money. You could take that dollar that I might have saved in my piggy bank in 1965 and could have bought 4 sodas then. It will buy a half a soda now. So you don't want the government giving you back 30 years from now 10 grand plus some interest. You want them giving back the equivalent of 10 grand. That might be 100,000. You might need 100,000 to buy then what 10,000 would buy now. So the professor of finance says that's the only instrument out there where you don't have to worry about credit risk. You don't have to worry about being repaid, right? Because the issuer is the government and they print money. And you don't have to worry, other than them screwing around with the definition of inflation, you don't have to worry about losing money to inflation. Because if I say to you, I'm going to give you $10,000, and you say, okay, I'll give you 5% a year interest over that 30 years. What if inflation is 10% over that period? I've lost ground. He's made money because he's paying me back with cheaper dollars, right? So unless you're using that instrument, it's all financial guessing. And that's sort of one of the first things that people don't understand, and that is that idea of risk and reward. What you tend to hear a lot, a big phrase is, you've got to take more risk to get a greater reward. And in a sense, that's true, right? There is this risk-free rate, if you will. This is what you can buy, put in your bank account, and you can get this, and your money won't go up or down. It'll just earn its interest. But what people don't think about is when you take more risk, it's not flipped. So you need to take more risk to get a greater return. But if you take more risk, it doesn't mean you will get a greater return. We'll go back to the lottery example. That is a riskier investment. Does that mean you're going to get a greater return? Yeah, if you win. But that's it. And there's everything along that continuum, right? So if you take more risk, what you're saying is, I have the potential for more return now. But what you're really saying is more risk means more variability. And that variability can be on the downside. And we saw that in 2008, right? When people lost, people ready to retire lost 25, 35, 45% of what they'd saved their entire lives for. So there is this downside. And it's a downside that the industry doesn't really focus on, right? So what are our 3 simple rules? I'll get to strategies too. Our 3 simple rules are simplify, and that is the industry there's a value on having a lot of strategies out there. There's a value to the industry on promoting confusion. So what you need to do is think about how can I simplify the choices out there. If there are 10,000 mutual funds, if there are 20,000 different strategies, really, what can I understand? It's a little Warren Buffett-ish, I guess, in this regard. What can I understand and what can I know? And you get a little bit into sort of, from your philosophy classes, epistemology. What can I know and how do I know it, right? And so when you begin to strip those things away, what appears to be a lot of choice out there are a lot of the same choices dressed up as something else. So there's a lot of confusion. So the first rule is to simplify. The second rule is to look forward. That's another way of saying ignore past performance. Now, on just about any prospectus, any investment prospectus, the SEC mandates that you put on there that past performance is no guarantee of future results. Nobody believes that. Everybody promotes it. In fact, even though it's boldly on every prospectus, the first thing any mutual fund or any investor or any professional will tell you is, here's my track record. So what they're saying is, at the same time, the past performance has nothing to do with the future performance, but look at my past performance. And I promise you, they will show you good performance. Because what you can do, if you're a mutual fund company, is you can start 6 or 7 seed mutual funds. 3 years later, see who the winner was, merge them all into that one, and then market that one. Right? So suddenly, there were 5 losers, 1 big winner, and now that's the survivor fund. And they come to you and say, see, look how well we've done. Well, is that really the whole story? Is that how well they did, right? One is bound to do well, right? The other thing is, when you look at the studies of investment manager performance, whether it's hedge funds, whether it's mutual funds, any sort of pooled account, when you look at that data, and this is where, maybe I could point you to a resource, at least something that I'd say Michael and I agree with is John Bogle at Vanguard, right? Who they have the Vanguard mutual funds, which are the only mutual funds out there that are owned by their shareholders. So if you own shares in a Vanguard mutual fund, you are an owner in that fund. So there's not a third-party owner looking to make a profit there. You're the owner, and the profit you're looking for is return. As a result, what the mutual funds in the Vanguard family have always strived to do is consistently lower their expenses, lower their expenses. Because the lower your expenses, the more you get to keep. The more you get to keep, the more that gets to compound, right? And so most of the studies have shown is that this idea of beating the market is a fiction. And since it's a fiction, it's not that nobody beats the market. This is what confuses people. You say, well, you can't beat the market. And then people are presented with information that shows that somebody beat the market. Look, we beat the market over the last 5 years, over the last 10 years. We beat our benchmark. You're going to find that. It's the person who's come to you, generally speaking, who said, look, I just did 10 heads in a row. I know how to flip heads, right? But you don't see that necessarily. You've got to look beyond that. The person, I'll use one tangible example, and that is Bill Miller, who ran Legg Mason's Value Trust for years and years. And he acquired a reputation, which was true, that he kept beating his bogey, the benchmark, the S&P 500 index, right? The 500 largest capitalized companies in America. So he beat it over 3 years. He beat it over 4 years. He beat it over 5 years. Beat it over 6 years. Now the articles start getting written. Here's the guy who can do better than the market. It's worth paying him some money because he'll beat what you could do just in a passive strategy, and you still have some left over even after paying him. That's the idea, right? You want to, if you're going to pay something, they better earn enough more than you would on your own so that you still net more than you would have done on your own. Right? Otherwise, there's no value there. So 6 years, 7 years. Now there's more and more articles. Now he's on television shows. Now he's highly sought after. Now you are about to invest some money. You just inherited some money. It's time for you to invest. You're going to go and do research, aren't you? You're going to try to find that person who's going to do the best job. And you're going to find Bill Miller because he's done it year in and year out. He's done it better than anyone else, more than anyone else. You're going to check, you're going to read the articles. Oh, yes, he looks and he's very careful about the companies he selects and blah, blah, blah. And you're going to say, that all makes sense to me, right? He's trying to beat the market and he's beating the market. Thus, he's a market beater. So you invest after all that research and you feel very good about it. And the very next year, 2007, he gets crushed by the market. 2008 gets crushed by the market. 2009 gets crushed by the market. So you came in doing all your research, finding the guy who could beat the market. And for the next 3 years, you got totaled. And you really got totaled because you didn't benefit from having been there the first 6 years, so you don't have any profit buffer. You're just a loser. So really, when we go to simplify, what we recommend is essentially buying the broadest index that you can, right, at the lowest cost you can. In the book, essentially, we say you could create a 1 or 2 holding portfolio that would be just as good, and maybe better, than any other complicated strategy or portfolio out there. There's no reason to think it's any worse. There's really no reason to think it's any better. But at least you're controlling the thing that you can control, which is to say cost. And you're doing it at the least cost. One of the things I'll show you in just a second is a fee calculator that we developed, because what we find is that people don't understand, because they're not doing it in their head, and because it's sort of hidden, what the costs are for investing if you hire a manager. And most people hire a manager, one way or the other. You might hire a broker to help you with it because you have a life, right? You're living your life. This is like getting a plumber to fix your sink. This is getting somebody else to do that where they have some expertise, right? So most people hire a manager. You might hire a manager by participating in what's called a 401k when you have a job. And you're putting money in your 401k and you've got 4 or 5 investment options. Those investment options have some expenses associated with them. But if you hire a manager either directly, hi, I'm going to give you $100,000, manage my money, or if you put your money into a mutual fund where people pool their money together with a specific objective and hire a professional manager, 401k, you're going to hire a manager. There are going to be costs. People don't understand what those costs are, and I'll just go through those 3 costs with you so you have some sense. So again, simplify is the rule. That may be the rule, but what is the effect of the rule? What is the action you would take based on it? It would be to use as few and as inexpensive investment options as you can to cover the broad spectrum of what's out there to participate in the markets. Can you deviate from that? Is there a right or a wrong? Yes, you can deviate from that. And there is no right or wrong except in hindsight. That's the thing that's very hard for people to understand. Do better than that, right? If I have 10% in emerging markets, 5% in gold, and 90% in stock, large company stocks, versus 30% in bonds and 70% in small company stocks, which one of those will do better over the next 10, 15 years? I don't know. Nobody does. Which one's going to do better over the next 1 year? Nobody knows. Which one's going to do better next month? Nobody knows. Nobody knows. So what the industry likes to do is promote this notion of certainty because it makes you feel better that this is a quote unquote, and the term they'll use is optimized. They'll use math, a simple algebraic algorithm, to say you should have 13.5% in emerging markets, you should have this. And here's the thing behind that. Those programs, let's assume you've got 10 different assets in there. And by different assets, I mean you're investing in small company stocks, large company stocks, high yield bonds, government bonds, different types of investments. You've got 10 assets. To build one of these optimizers that creates a pie chart for you, that would tell you what to do or suggest what's the best way to go, what's the most return, what's the most expected return you can get out of this given the risk you're willing to take. You've got 64 inputs, okay? For 10 assets, you have 64 inputs. Those inputs are related to standard deviation, which is the volatility. The other ones are the expected return. For bonds, over the next 10 years, what do we expect it to earn? For stocks, what do we expect it to earn? And the other one is the correlation. How do they move against each other? If bonds go up, how do stocks go down? How do these 10 assets move against each other? So there are 64 inputs. You run it through the program. It tells you, it gives you a pie chart on how to invest. That's called the optimized portfolio. Every one of those 64 is a guess. Every single one of them is a guess. And yet somehow we're supposed to treat the output as a certainty. Now in very, very small letters, on the very last page, it's not what is played out. But that's how we treat it. So one of the things that I'd like to suggest to you is that although there are a lot of strategies out there, although there's a lot of options, although there's a lot of confusion, although the industry will tell you over and over again that there is a way to come up with an answer, fight that impulse. Fight that impulse to think that there is an answer. That there is essentially what they're saying is there's a way to use math to predict the future. So think of, anytime you see a pie chart recommending what you should do, think of that as being, forgive me if you believe in these, a horoscope. And the parallels are striking. If you read 10 horoscopes and then read 10 analyst reports and just step back from it and just take the words a little bit out, go a little meta, go a little back, you'll be reading something that sounds very much the same, with the same caveats, with the same sort of if this happens and that'll happen. We think this will happen, but if it doesn't, this will happen. Just read very carefully. Use your English major skills, use your critical reading skills that they teach at Georgetown to approach this skeptically and say, what at the end of the day have they just told me? You'll The industry is very careful. They won't say things that aren't true, but they will say things that sound true, right? So that's one of the things. Now, right now, I think that I want to tell you at least one podcast and one book that I would recommend. One podcast is, and you may have read the books already, there are 3 of them out: Freakonomics, Super Freakonomics, and Think Like a Freak. This is Stephen Levitt out of University of Chicago, Booth School, and Stephen Dubner, who used to write for the New York Times. The 2 of them have teamed up to write these 3 books. And basically, the subtitle of their books are The Hidden Side of Everything. And I think that's sort of the approach you have to take to investing. I think it was Goebbels, Hitler's, I don't know what he did in the war. Anyway, he had some sort of phrase that was, if you're going to tell a lie, it has to be a big lie. And just repeat it over and over again, and people will believe it. And that's what the financial industry does. And you've got to see beyond that. You've got to see the hidden side. You've got to read investment articles critically and say, at the end of the day, are they actually saying something, or does it sound like they're saying something? Right? So that's one thing I'd encourage you. And that will help you simplify. Knowing that you can have a portfolio with as few as 2 holdings that will make you the most diversified investor on the planet, and do so at basically 5 basis points, a fifth of a percent, as opposed to what most people are paying 2 and 3% a year. Huge difference, and that's what I'll show you next. So let me use one tangible example. Warren Buffett. Warren Buffett, when he dies, he's instructed his trustees to do 2 things. 10% in cash, liquidity, I guess, 90% in the Vanguard Total Stock Index Fund. That's it. That's Warren Buffett's plan for his investments. I think he does what he does now because he enjoys it. He's having fun buying companies. Who wouldn't, right? This is a great thing. But he knows that when he dies, he doesn't want anybody who's having fun and enjoying it. And he knows probably that although he's good, he can't pick the next him. And that goes back to my earlier point. It's not that no one beats the market. People beat the market all the time. You just don't know who's about to beat the market. So rather than trying to beat the market, try to be the market at the lowest possible cost, and you'll beat almost everybody. And Buffett himself knows it. Buffett knows that there's no complicated mechanism. There's no strategy. You notice he doesn't say, hey, find the best hedge fund manager and short everything. There's no prescription there. He's saying, when I die, put it all here and let it ride. Would I argue that maybe you should do a total world stock index fund instead of U.S.? Yeah, maybe. Who's right, who's wrong? Fine with either. He's a patriot. He's a big U.S. guy, so that's what he's going to say. He probably won't go wrong. But empires do fall. So especially when they overreach. Not that we would. We would never overreach. So I might have a slightly different take on it, but I think that that's telling. Here's a guy who knows markets, who's been in markets forever, who has done well in markets forever. What does he do when it's not him managing it? Because this is his opportunity to select a manager other than himself, and he chooses the Vanguard Total Stock Index Fund and 10% cash. Right? I think that's a telling lesson. That's simplify. Look always forward is just another way of saying ignore the past, it'll fool you. We think of the past as monolithic. The past is not monolithic. The past is a series of stories, and you can prove or disprove a number of things depending on which story you pick, depending on which time frame you pick. Right? So there are a lot of lessons from history that aren't really lessons because you've also learned the opposite lesson too. You see that with cliches that actually are counter to each other. And the third one is tune out the noise. And there was a book that came out years ago called Don't Sweat the Small Stuff, and it's all small stuff. So tune out the noise is essentially don't bother. Don't watch CNBC. Don't get in a tizzy. Don't read the Wall Street Journal. Don't read Barron's. Don't do anything. Warren Buffett didn't say, I want my trustees to be the best educated and read Barron's and keep up and find tips. And he doesn't even say, look for the best value, right? Which is what he's always known for saying. He looks for good value, right? As if that's a thing, right? Let's assume that Coca-Cola, that God comes down and says, Coca-Cola is a $40 a share stock. That's it. By December 30th, it's going to be $40 a share. If you knew that with a certainty, would that trade at $30? Would it trade at 30? No. People would keep driving it up because you know on December 31st it's going to be worth 40. You would go right up to buying it at $39.99. If you're Goldman, you'd lever it and put all of your money in there because even for that penny, that's a gain, right? And it's a sure gain. So people all the time say, you buy a good value stock, look at it, it's been beaten down or whatever. Or I think this stock's worth 40, it's selling for 30, it's a great value. I think that's a little hubristic because you're forgetting there are people on the other side of these trades, right? If it's selling for 30, that's the collective wisdom. Goes back to your question, the efficient market hypothesis, right? What is a price? The price is everybody's collective information. It's what everybody knows. Now, you may come and say, Coca-Cola, I think it should be at 40. I've done my research. It should be at 40. It's selling at 30. I'm going to buy it at 30 because it's a good value. You're basically telling me that you know more than everyone out there. Because if Goldman knew it was worth 35, they'd buy it right up to $34.99. But it's at 30, right? So they haven't done that. Nobody's done it. JP Morgan hasn't done it. Nobody's driven that from 30 to 40. So you think it's 40, but no one else does, pretty much. And all that information is in the price. Whatever the price is now, does that mean it's right? I don't know if it means it's right. It means it's right now with everything that's out there with what everybody thinks. But when you go to buy that stock at 30 with the feeling that it should be 40, you're basically saying you know more than everyone else, when in fact you don't even know who everyone else is or what they know, right? You're assuming that what you know is in fact everything that can be known. And you're not just saying what can be known about Coke. You're saying what can be known about the interconnectedness of a global economy. You're saying that you know what monetary policy China is about to do that's going to affect the price of Coke better than anyone else. I don't know why you think that. So we say buy low, sell high. We say look for good value. You'll read a book, and they'll say, read about the management team. Read about how good they are and how they work well together and what good decisions they made. Read about, read their annual report. Figure out what. Are you kidding me? Really? You're going to predict? It's tea leaves. It's tea leaves. But the market, the collective wisdom, has said, they've told you something. There's a price. Price is 30. Right now, that's the right price. It's just as likely to go up as it is to go down, and that's why a lot of the models use Brownian motion, in their mathematical equations. Where's the stock going? Don't know. Any number of things could change. Coke could come out with a new product that everybody loves, and somehow the market could tank, a la 2008, and price-earnings ratios go from 25 down to 9, and everyone, including Coke, right? Not that they're not doing well. They might be. Not that they won't be profitable. They might be. But their stock price takes a hammer, and you lose. So simplify, tune out noise, simplify, look always forward, which is not saying, and we probably need to clarify that better from talks we've had. We're not saying predict the future. We're just saying don't look back and just focus on what you can control going forward. So I'm going to do one thing, and I think they've got some tchotchkes here to hang out. I'm going to ask a couple questions. So a lot of people invest in mutual funds. I mentioned that. This is where investors pool their money and they hire an investment manager with a specific objective. So let's just assume it's a growth mutual fund that's going to invest in large company stocks. The average mutual fund has an expense ratio. You never write a check for it, but it's embedded. The cost of being in that mutual fund is taken out every day at the end of the day. But in the prospectus, it'll tell you what the expense ratio is. So a lot of actively managed funds, where they're trying to beat the market and using their research and all that, have expense ratios of 1%, 1.5%, 1.25%, something like that per year. As I say, you never write a check. It's not hidden, but you don't feel it, right? So there's a little distinction there. It's hidden in the sense that you never pay it, but it's fully disclosed. Okay? And then a lot of people hire investment managers. And those investment managers will ask you questions about your risk tolerance and ask you about your goals and what you're trying to do. And they're the ones who will put your information into one of these means variance optimizers and come up with that pie chart on how you should invest. They charge money too. Typically 1% of assets under management, right? So those are your two costs, the internal cost and then your advisor costs. So we built a fee calculator to show you over time, if this comes back on, does it? Yes? I'll ask a question. We have these extra. There's the fee calculator. I think it goes right here. There's some defaults. Look up here. There's the investment. Can you see this? Is that easy enough to see? The investment amount is $50,000 over the next 30 years. So you're talking about when you start early, we're talking about compounding. This is reverse compounding. This is the compounding of your expenses. So your investment period is 30 years. We're assuming you get an 8% return over time. Maybe that's high, maybe that's low. Who knows, right? Then your mutual fund fees of 1.25%, your advisor fee of 1%. Now, that $50,000 really grows to a total of $500,000. You keep $267,000 of that. You give away to the mutual fund company in fees $47,000. You give away to your advisor $37,000. And you lose $150,000 on the money you would have earned if you hadn't been paying those fees. So that's something. Most people are surprised by how much this adds up to over time, how much you're paying the mutual fund. You had a $50,000 investment, and you're paying $50,000 over time in investment management fees. You're paying your advisor $37,000. But it's really what you've given away and now is no longer compounding that is the difference. So if you could simplify and not have an investment manager, like Warren Buffett's not going to do, right? See if I can make this work. I'm going to change that. That's 0. We got rid of the investment manager, and we put our money in what Warren Buffett's putting it in, the Vanguard. Look at the pie chart. That's not 0.5, sorry, it's 0.05. Look at the difference. Instead of giving away half in fees, you now, of the $500,000, you keep $496,000. So if there's any sort of message here, it's compounding matters, not only in terms of what you're investing in and how that doubles on itself, but don't forget, fees compound too. Fees are money that you no longer have. You've given it away, so it's no longer in your account, right? It's a very, very real cost. It may not be a fee, you may not be paying it, but it's a cost. So simplify, tune out the noise. It's all noise. It's all noise. Now we need this noise because we're free riders, right? We're free riding on all those people who are duking it out. But there'll be plenty of them. They're all fighting about the price, what the price should be. But for the moment, all their fights, all of their research, all of the money they put into the MBAs, right, that work at JP Morgan at Citi, they're all doing your work for you. They're battling it out in the marketplace, creating what we call price. And that price creates the efficient market we were talking about so that you can benefit by it and invest in an index fund and get rid of the investment advisor. Now, you might hire somebody to help you with your taxes. You might hire them to do some spreadsheeting. But these days, I mean, at least in this room, most of you can probably do a future value calculation on your Excel spreadsheet or something like that to see where you're going. And increasingly, there are online opportunities for investments, personal capital or invest and things like that. So let me just list one more book. I would read The Black Swan by Nassim Taleb. If you haven't read it, Think Like a Freak by those guys. And fellow Georgetown graduate, class of 1986, Michael Mauboussin, who was the chief investment strategist at Legg Mason, is now up at Credit Suisse, wrote a book called The Success Equation, Untangling Skill and Luck in Business, Sports, and Investing. Because you really have to untangle how much is luck, how much is skill. Because if it's skill, it's probably worth paying for. If it's luck, go this way.